Hey everyone, I'm Jeremy Szafron. This is Kitco News. Well, we're wrapping up September and Q3 with plenty happening in the gold market. Right now, gold spot prices are sitting above $2,600, and it's been a busy session with prices swinging just a little as we see some profit taking. Well, let's not forget, on Friday, we saw December gold soar past $2,700 per ounce, hitting a key target that our very own Gary Wagner called perfectly just a couple of weeks ago. Now, it's not just the traders making moves here. There's some serious tensions brewing in the Middle East. Israel's strikes against Hezbollah leaders have sparked geopolitical concerns, keeping that safe haven demand alive. And well, of course, we will continue to monitor that situation as it's unfolding. And at the same time, China rolled out new economic stimulus measures over the weekend, lowering mortgage rates in an effort to revive their slumping property market. Now, global markets are paying attention, but with China on holiday this whole week, we may have to wait a little longer to see the full impact. And on the technical side, gold is sitting at a pivotal point. So let's break it down and welcome back our friend Gary Wagner, of course, editor of thegoldforecast.com. Gary, great to see you as always. As I just mentioned, you've been spot on with your call on that $2,700 target. How are you feeling about the market's near-term future here, my friend?
Well, first, thanks for having me. I do believe that we could be entering what I call a shallow correction, meaning when we consider the move that gold has accomplished from this last leg of the rally. It's been a historical move to multiple all-time record highs and closes. I believe that we have peaked out on a short-term basis, that gold most likely will correct. And we'll look at a couple of models on one of my charts that I prepared for us today. And after the conclusion of the correction or price retracement, I think that we do have yet one more leg of the rally to complete what we're labeling as the impulse phase, which in terms of Elliott wave terminology represents the 5 impulse waves 1 through 5, where 1, 3, and 5 move in the direction of the primary trend, which is, of course, up.
Okay. There's lots to unpack here. Let's bring up that chart because, as I mentioned, you had your correct call on $2,700 Friday. We're seeing what you just called a correction. I mean, is this just typical profit taking from short-term traders? Is it, the broader consolidation phase? Where are we at? Break it down for us, Gary.
Well, I absolutely think that this is an opportunity for traders to bank profits. The move has been phenomenal. What we are looking at on this first chart is a daily candlestick chart of the continuous contract of gold futures. And what we've identified is a simple pattern called a tower top. And what you look for in a tower top is after you get a sizable rally, you start to get a couple of equal highs as well as closes. This green candle here, the top represents the close. It's identical to the opening price on the following day, this being Friday. And that's when we saw that there was a likelihood that we could be seeing gold correct. Also, on the bottom third of the screen on this chart is the MACD, the moving average convergence divergence. And you can see that it is over a level that we look at as potentially overbought. And so this is when we would look for potential signs that gold is correcting. The next chart that we'll simply look at, and let me go ahead and pull that up, is also a daily candlestick chart of gold. The difference is on the bottom third, I have a stochastic oscillator. Stochastics are something that have been used by technical traders for as long as I've been a technical analyst. And simply what it does is it compares current pricing to the highest high or the lowest low over a period of days. So in the case, you've got two lines. One represents current price in relationship to the highest highs or lowest lows. And these peaks above 80 are when current pricing is very close to the highest highs over the period that we're looking at. And then what we look for is this blue line to cross below the orange line. The other line is a basically an average, a moving average of the first line, percent K and percent D. But to simplify it, we look for it to A, in an overbought scenario, go over 80, which is what this line represents here. And then we look for a cross as an indication. Now, I put an arrow up to other occasions in which it really peaked and crossed. And you can see if we look up to the top, that was a good signal that a correction followed. The second example, that occurred in the middle of July, the same thing. In other words, the stochastic oscillators both move above 80, and then you get a cross from the blue line crossing under the orange line, and you can see that prices went down. Also here, we've basically got some channel lines, which really illustrates the rally that came in and how nicely it kind of unfolded. In other words, recently we had what I'm calling a near parabolic move. In other words, we had almost a straight linear line up to Friday's intraday high just above $2,700. I am labeling major support at about $2,610, and resistance is just above $2,700. And that, of course, is based on the high that came in last week. In the case of right now, it would be Thursday's intraday high and Friday's move. So I think that what we're seeing in these first two charts is the setup or early warning signs that we could, in fact, be on the precipice of some sort of price correction.
Yeah, interesting. And so if we do see that price correction, I mean, how low is it going to go? I mean, you talked about maybe 26.35. There seems to be some good support here, too.
Well, we are looking at a chart in which I'm going to present the models of one likely scenario. And what we are doing here, this is my master chart with my full Elliott wave count, Fibonacci extensions, and Fibonacci retracements. So what we do is we measure the distance gold move from the bottom or end of this correction up to the recent top, what we are labeling as a primary third wave. And so we moved from roughly, call it $2,400 up to $2,700. And then we look at different levels that it could correct to. And what we're doing is looking at a Fibonacci retracement, and the shallowest retracement would be a 23.6, and that would take gold down to $2,635. A deeper correction would be a 38.2% extension, taking gold just below 2,600 to 2,590. The reason that I believe it will be a shallow correction is the typical model in Elliott wave. There's a 5-wave sequence called the impulse phase, in which waves 1, 3, and 5 move in the primary trend direction, which of course has been up, and waves 2 and 4 are corrective waves. And on a corrective wave, we look for one to be an extremely deep correction beyond a 61% retracement, and the other one to be a shallow correction. And so when we look at this wave 1, which took gold from roughly 2360 up to 2530, the correction itself came in just below the 78% retracement. And that's what this line here represents. And you do have some wicks that come in there, meaning the tails or the intraday low. And so if we've had a deep correction, the most plausible model would suggest a more shallow correction. So if we are correct and gold truly corrects from here rather than it being a one and done, or in the case of current analysis, two and done, because we had a sell-off on Friday and follow through today, we could see gold trade as low as 26.35 and as low as $2,590.
Yeah, $2,590. But it's pretty crazy. I mean, $2,590, we would have taken that gold price just weeks ago, Gary. Okay, well then talk to me a little bit. Talk to me about the flip side then, this all impulse phase. What kind of gains could we see if we bust through that resistance level here and we start going the opposite direction?
Okay, so in this model, I am looking at these two price points, 26.35, 25.90 as potential bottoms. From there, we would go into a final fifth wave. And in Elliott wave modeling, one of the simplest formulas to follow for a fifth wave is that wave 1 and wave 5 have the same price move. In other words, if wave 1 was a gain of $200, we would expect the gain of the fifth wave to be $200. So that's all I'm doing is basically modeling the price move here and extending it. If gold has topped, corrects to a shallow 23.6% retracement, we would see gold go to 26.35 and then move back up to a top of about $2,765. If it is a deeper correction to $2,590, we would expect the fifth wave to have the same price move in terms of distance, but only reach just above 2,700 at 2,723, 27.25. Yeah. And that would conclude the impulse phase.
Yeah, wild. We got to keep an eye on it. Okay, we've recently also seen the U.S. dollar remaining relatively strong, which typically pressures gold. Do you think that the safe haven flows tied to this geopolitical risk that I talked about could maybe outweigh that dollar strength, or is the strong dollar likely to keep a lid on gold's upside?
Well, one thing that we can always say about the price of gold is that sometimes when gold runs to the upside with dollar strength, it has the ability to overcome that strength. There is a 100% correlation between dollar strength or weakness and gold moving higher or lower, because we pair gold against the dollar. So obviously there has to be a direct 100% correlation. If we look at this longer term dollar index chart that I've put up, we can see that the low that came in just above 100 at 100.24, and it is below the low that came in back in the end of December, beginning of January. That one came in just above that, and it is still above this low that occurred in July of 2023. So that's what we would want to see. If the dollar holds in this area, we're going to look at different areas it could go for technical levels, because the fundamentals will drive the dollar higher or lower, but technical levels will give us an indication of where that rally or correction could conclude. So the first thing is we look at these tops. They came in at around 101.70. That would be the first area. The second area, and this is under the scenario that the dollar is going to get stronger, it's going to gain value against the basket of currencies that the index is paired against, we would look for a move possibly as high as 102 or even 104. Now realize every percentage point up, or every move up, meaning from 100 to 101, represents a full percentage point of gained value if the dollar is getting stronger, or of value that has kind of come out of the dollar as it relates to this basket that contains 6 or 7 currencies, but the euro being the highest weight of that basket.
Okay, Gary, before I let you go, you and I talk macro on the show all the time. I know you spend a lot of time, looking at that as well. There's speculation that the Federal Reserve could cut rates again before the end of the year. Some saying up to 50 basis points. I know Powell was doing a pre-tape discussion, sounding a bit dovish. But do you think that a more dovish Fed would push gold prices higher? Or do you think, data could weigh gold down here?
Absolutely, continued rate cuts by the Federal Reserve will provide bullish tailwinds for gold, unquestionably. Right now, the anticipation is that during the final two FOMC meetings of the year, each meeting they will announce a rate cut of a smaller 25 basis points. Now, anything is possible. And as new data and reports come in, the Federal Reserve will use that and pivot from maybe a 25 basis points cut to a 0.5% if they deem that that's the best action to stimulate the economy. One interesting facet of what Powell said this morning is that the jumbo 50 basis point rate cut was not done to stave off a recession, but he put a different spin on it. He said, rather, it's to take a strong economy and make it stronger. In other words, he doesn't want it perceived that the Federal Reserve is enacting these steps to stave off something, but rather than to support something good in the economy. And I thought that was interesting. Yeah. But I think most likely we will see a total of 1% come off of Fed funds rate, with a 50 basis point cut already enacted and two more 25 basis point cuts at the last two meetings in November and December.
Yeah, well done. Okay, well, we'll stick around and wait for it. And of course, I always appreciate you coming on twice. So every 2 weeks, Gary, we get to sit down for a date. I know a lot of the viewers always respond, and you got a special offer for them.
Well, I do. I wanted to thank our loyal viewers that have been hanging in with us and looking at gold. And this is such a fascinating time that what we want to do is offer a special price for our Kitco listeners. And so if you go to our website, thegoldforecast.com, and you go to the pricing page, there'll be pricing for different lengths by the month, a quarter, or yearly. But there's a box that says enter code. And if they type in the word Kitco, they will receive an extra 30% off of our regular price. We've never done anything like this, but we're doing this because we really believe that loyalty of our viewers has been building, and it should be rewarded. So a 30% discount by typing in Kitco on the pricing page.
Yeah, right on, mate. I appreciate that. We'll put down a link in the bio as well. Gary Wagner, of course, editor of thegoldforecast.com, and our resident technical analyst from Hawaii, breaking it down. Gary, thanks again. Appreciate your time.
Thanks for having me. Look forward to doing this again in 2 weeks.
Yeah, you betcha. Our little bi-weekly dating. Okay, we'll see you soon. We'll see you then. I'm Gary Szafron. Appreciate it for Kitco News. Of course, it's a big week in the market. Lots of economic data coming out. Towards the end of the week, of course, we'll hear about the jobs, and we'll have the latest on it. For all of us here at Kitco News, thank you for tuning in. Stay tuned. We'll see you next time.